Hello, dosto. My name is Deepak and I'm a tax code advisor. And today's tax question is about real estate partnership. I love the question because I think it's going to save somebody a lot of money. And if you're into real estate, you think about investing into real estate, then I think you're going to love this question as well. So hear me out. I think you're going to find a lot of value in it. So imagine you are working at your company and somebody walk up to you and say, hey, you know what? I have this real estate business going on and I'm doing very well. I buy properties, I upgrade them, I fix them up, and then I turn around and sell them. Every time I do that transaction, I make $100,000 on it. My business has grown quite a bit. I don't have time to go and manage each one of those businesses. I would like to bring you into the deal. And if you help me out run that business, I'm going to give you 25% share in my company because I set up a new company for each property. I'll give you 25% stake in it. Now, from your point of view, that's an awesome deal. From their point of view, hey, I'm getting an employee to work for me free because I don't have to pay him anything until our deal actually closes. And maybe it closes, maybe it doesn't close. That's a different story. But at least I don't have to come up with any money from my pocket, and I get a free employee who's able to manage everything for me. So sounds like a win-win situation. And especially if it's scalable, if it's somebody who is so good that they're able to do it again and again, that's awesome. So I'm going to read out a question that came today, and then maybe I'll give it a little bit of a twist on it and even make it more complicated. And we'll try to take a look at a couple of these scenarios, how they work out, what kind of things that you want to watch out for, how can that cost you money, how can you structure it in such a way that it is in your favor. Now, taxes are complicated, seriously. Sometimes just structuring a transaction a certain way can save you a lot of money. And I think this is a prime example of that. Now, there are so many other little pointers that comes around partnership. So in no shape, way, or form, this video is going to be complete. Right now, I'm just going to focus on answering that one question only. But trust me, there are many other things you want to look at. Anytime you're thinking about partnering up with someone, I'd recommend clients to go through a comprehensive consultation. It usually takes 6-8 hours. We talk to each partner, we come up with a plan, we take a look at from a tax point of view, we structure it properly and get it done the proper way. So anyhow, the reason I'm telling you that, you should not hear this 10-15 minute video and try to make a decision on partnership. Most likely, it's going to be a very costly decision. Those of you guys who are new to my channel, my name is Deepak and I'm a tax code advisor. I talk about taxes whole day long. I talk about financial markets, real estate markets, but I am not an investment advisor. So I'm not here to give you an investment advice. If you're looking for some help with your taxes, then I'm certainly your guy. But that's about it. And even tax advice, that's not in videos. Tax advice, you want to get some good tax advice, you want to figure out how you can save taxes, well, guess what? We got to do one-on-one consultation because without that, I have no idea what's going to work for you. All right. So hopefully we are good with that. Let me read out the question and then we'll jump into this real estate partnership stuff. The question is, Deepak, I have an opportunity to participate in a partnership with a friend of mine. He's very good into real estate. He's buying properties almost every couple of months, upgrading them and turn around, sell them. Each property he makes almost a couple $100,000 profit. He's looking for someone to manage those for him, and he's willing to give up to 50% equity into his business. Should I take it? Anything I need to worry about? So what are your thoughts? Okay. This one is a little bit complicated because you didn't really say, is he selling you the equity or he's giving it to you? Because the way you sounded like the question is that he's giving you the equity. You're not really buying an equity, because if you buy an equity, you become a partner, right? Or an investor. Like I can go buy an equity in Apple or Google or Palantir. I guess if I wanted to buy it, I'll probably buy Palantir right now than Google, because Google is after the earnings is down this time, and Palantir is having a time of the year. Anyhow, that's a different story. But that's just me. Not a financial advisor, again, as a reminder. So, sorry. I think what you're really saying is that he wants to give you the equity. So meaning he's saying, hey, come here, do some work for me, help me out run this business, and in return, I'm going to give you 50% equity into that LLC. First of all, I think he might not even understand what he's really doing in terms of taxes. Because what happens is, let's just say you buy a property in Fremont, California, and you buy it for $1 million, or he buys it for $1 million and fixes it up and sells it for $2 million, right? And he says, hey, come help me out, fix it up and whatnot. And he gives you 50% equity. But from an IRS point of view, IRS says, wait a minute, what is this 50% equity for? Well, this equity is for me working. So it's a compensation, right? And compensation is different than profit sharing. So when we look into partnerships, we have to make sure the deal is structured in a way that it is not treated as compensation. It should be treated as a profit share. And there are subtle differences. One little mistake can make you put you on one side of the camp. Now, why do I care about that? Well, because on a compensation, we pay ordinary income taxes. Even on profit sharing, but depending upon profit sharing has a lot of other flexibility. So let's not go there. Most of us are going to pay more taxes if it's an ordinary income, if it's a regular compensation. So my problem here is this, that if it's $1 million property and he gives you 50% equity in it, he has just given you a $500,000 compensation and you're going to get hit with the tax bill. So if you're a 30% tax bracket plus your state, you might be on the hook for $150,000, $200,000 in taxes. Doesn't sound too exciting because nothing had even come into your pocket. You don't even know if that property is actually going to sell. He hasn't made any money, but all you have done is created yourself a tax bill. So not good. I do not like that idea. That's not how I'm going to structure it. So that's one thing you have to be very careful with. So before you do anything, certainly talk to a tax professional and structure the deal properly. Now, having that said, how should we structure it? Well, what we're going to structure it is we can still set up an LLC and still make you guys a partners. That's not a problem. But it is how we make you the partners and how we structure the deal on your operating agreement and in accounting. That's what matters here. So what I'm going to do, for example, and I'll say, look, let's say we go with the same example. Let's say the property is $1 million and upgrade cost, let's say another $500,000. So let's say $1.5 million is the total cost to get this project finished from end to end. So what I'm going to do is I'm going to set up 2 capital accounts within your LLC. One capital account is for your partner who is funding that LLC, and another capital account would be for you who is not funding the LLC. So $1.5 million comes from partner number 1, $0 come from partner number 2, but we do need to account for both of those. Now we're funded, the company's all set. Now you go work, you operate, you do things, get the business going, and 2 months down the road, you're ready to sell it for $2 million. Now what happens? Once you sell it, first thing we are going to do is pay back the capital. The capital was $1.5 million, so we pay back the partner number 1 for $1.5 million. Because it was his initial investment, certainly no taxes due for him. He just got his money back. Now we have a $500,000 sitting in the company as profit. We take that profit and we split it half and half. $250K for you, $250K for him, and we are good to go. Now, I oversimplified it in my example here because there are many other things to consider. For example, for him, that $250,000 is a simple passive income because he was not really involved in the business at all. But for you, that's an active income. So that makes a whole lot of difference as to how deductions, depreciations, all of that stuff work. So we're not going to get into that. On top of that, then there are some other tax issues. For example, do we pay FICA taxes or we don't pay FICA taxes on it? How do we structure it? What if, for example, he's sitting in his air-conditioned office, let's say in Florida, and here you're going to the property every single day. Maybe you want to buy a car and you want to show it as a deduction, but you're like, wait a minute, I don't want to put $50,000 car on my LLC books. How do we deal with that? So, like I said, I oversimplified just to answer your question as to how should you structure it. The main idea I want you to understand today is the difference between compensation and a profit share. There are a lot more other issues that we need to deal with. That's why I said earlier, it's important that we do a proper detailed conversation to understand what's going on in your business. Now, I'm going to make it a little bit more complicated. In this case, he starts a new project every time. But sometime I will meet with people and they will say, Deepak, we already have a business. We already got, partnership going on. Maybe let's just make a guess. Let's say you are 70%, I am 30%. Two of us have a restaurant already. Okay. And now that restaurant is not doing very well. So we go and find a new cook who is really, really good. And we go to that cook and we say, look, we're going to give you 25% equity in this business if you come join us. Okay. Same problem. If I say it that way and he understands it that way, and it's just a simple LLC without any operating agreement, without defining these capital accounts, without defining the structure of LLC, because you don't do all of this when you register a company. So a lot of people miss this part, and then they come to me during tax time and I'm looking at them like, wait a minute, nobody had this conversation with you about all that? Like, no, nobody talked about this. So this creates a problem for the cook, for me, for my partner. It gets really messy. So let's talk about how are we going to deal with that. Same way, I'm going to redefine the operating agreement for my LLC. It's going to change. So there will be some attorney work involved here. And what I'm going to do is this time I'm going to set up 3 capital accounts in my company. Okay. And what will happen is in one capital account will be for my cook, which will be starting with 0, but he will have a 25% of net profit from the business. So let's say restaurant make $100,000. First 25% of that will go to him. $25,000 out of that $100,000 goes to him. Now the company is left with $75,000. I'm going to take 70% of that $75,000 and pay you because you were the 70% partner in the original LLC that we had created, which existed before even the cook came into the picture. And then 25% left over, obviously that would be my profit share. Once again, oversimplified just to make that point. But that's how you set this up. So there are a lot of moving pieces. So if you want to get involved in partnerships, please don't jump into it. Certainly don't file any paperwork because most likely it is going to cost you a lot of money once you do it. I see it all the time. Sometimes people even reach out for consultation. After that, they go like, you know what, it's just my friend or my brother or my cousin. Let me just do it. And they do it, and a few months later, when their tax time comes, or when they're ready to sell the project, or when they're ready to take the profits out, now everything is a mess. So it's so important that we do it properly on day one. So anyhow, I hope I didn't lost you there. Hopefully it makes sense. But if you have a tax question, I'm here to help, right? Just go to taxcodeadvisors.com. You can always set up a free discovery call. We can jump on a call, tell me what's going on with your tax situation. I'll let you know how much it's going to cost you to file your taxes with us, and we'll take a good care of you. We work nationwide, so no matter where you're in the country, if you need help filing your taxes, you need help figuring out how can you lower your taxes, I'm your guy. All right, I'll see you next time. Till then, goodbye.